Welcome to Turning Hard Times to Good Times. I am your host, Jay Taylor, speaking to you from the borough of Queens. It is the 21st day of June, 2022. And I'd like to remind you that I publish a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. You can sign up for that by going to miningstocks.com, miningstocks.com. You can call our office here in New York as well during normal work hours at 718-457-1426. We do like to remind you of Michael Oliver's Momentum and Structural Analysis letter, an excellent letter, one that I can't really do without. OliverMSA.com is the place to go to sign up for Michael's letter. And we also like to plug Chen Lin's work. What is Chen buying? What is Chen selling? Then you can go to chenpicks.com for that. Chen is especially strong on the biotechs, and a few of those that I'm following myself in my own newsletter because I find them really exciting, potentially big winners. So chenpicks.com for Chen Lin's letter, What is Chen buying? What is Chen selling? I want to thank all of you for listening to this show and making it one of the more popular shows in the Voice America Business Channel. Also like to encourage you to send along whatever questions and comments you might have about the show to questionsfortaylor@gmail.com, questions 4taylor@gmail.com. We do want to thank our sponsors making this show economically viable. They are, for this week, Irving Resources, Novo Resources, El Oro Resources, Core Assets Corp., SK Mining, Timberline Resources, Lion One Metals, and Rena Gold Corp. Before I talk about today's show, I want to mention a listener to this show who I met at a LL Bean store in Yonkers, New York this past weekend. And I was shopping there with my wife when I heard this guy named James Perito call out my name. He apparently recognized me from my YouTube channel where he listens to this show frequently. Longtime listener, he says. As is true with many of the listeners to this show, one of James' favorite guests is Michael Oliver, who will be with us in just a few minutes. I'm used to meeting listeners at various conferences that I speak at, but it's really cool to meet up with someone out of the blue, like James, along with his wife, just casually walking along in a store, and met up with him, and he recognized me. And I'm very honored to have my pictures taken with James and his son and wife. It was really a fun time. My friends like to kid me about having a great face for radio. So I guess I have to be thankful to YouTube. Otherwise, I never would have met James. Anyway, it was a lot of fun, and always fun to meet listeners to this show. As I say, most often I meet them at conferences that I speak at, but that was a lot of fun. Anyway, today's show I've titled Why PhD Economists Don't Really Understand Inflation. Jeff Deist, Michael Oliver, Patrick Highsmith are guests this week. Suddenly, with exploding consumer prices stripping the fruits of labor away from average Americans and thus threatening the political status quo, TV talking heads have set aside concerns about COVID and Ukraine to focus on what Americans really care most about, namely the ability to put food on their table and gas in their cars. But do most of the talking heads on TV actually know what inflation really is? Is it simply rising prices, or is there more to it? When stock and bond prices rise to levels far in excess of their underlying historic intrinsic values, might that also be a form of inflation? Not only are average folks ignorant of what inflation really is, but so are those who are supposed to know and understand it. I'm speaking of the heavily indoctrinated Keynesian PhD economists that have increasingly fostered the idea that printing money to pay for trillions of dollars of government spending is not inflationary. But I think we may now be seeing the end of that big lie, because the mathematics of massive debt growth, which is growing exponentially against very slow income growth, is leading the Western world towards bankruptcy. And the massive rise in inflation is starting to reveal that truth, in my view, to those at least who have eyes to see. I addressed the cause of America's financial decline in my Metals Investor Forum presentation, which you can watch via YouTube. Simply go to miningstocks.com, and scroll down to the significant weekly market headlines section. And right at the top there will be a link to my talk, which I titled Back to an Honest Monetary System. And in the second half of today's show, Jeff Deist, the president of Mises Institute, will share his thoughts on those and related topics as well. In the second segment of today's show, Patrick Highsmith will join me to update us on the emerging high-grade Carlin-style Nevada gold discovery. But right now, I'm happy to tell you that Michael Oliver is with me once again to give us his latest thoughts on these turbulent markets. Thanks for joining me, Michael.
Hi, Jay. Good to be back.
Always good to have you with me. And your front page article, this week's 360-degree weekend report, was you featured NASDAQ 100, and it shows some rather ominous signs, if I'm reading the charts correctly. At least if you're bullish, it's ominous. Today, the bulls seem to be having a pretty good time of it. Does today's rally in any way change your views of the NASDAQ?
No, not at all. There'll be rallies all the way down. Our assessment is the top is in place. We said that in January for the NASDAQ 100, in February for the S&P. Euro Stoxx 50, which is blue chips of Europe, they broke coincident with that. So we're getting consensus. And when we say break, we don't mean something that broke that'll likely, run 3 months and then that's it. We're talking about something that could run a year and a half or two. We're talking about an annual momentum decline. We're talking major bear market, just like in 2000 or just like in 2007, once they made their peaks. It took a while. And there were great rallies all the way down, teasing rallies. And you continue to hear it on the financial TV channels about, where do you buy the dip? And it's not a dip, it's a bear market. Anyway, but what's from an asset manager's point of view, and pardon me if I've made this point before, but I need to make it again, and we do in our weekly reports. If you're an asset manager, there are certain acceptable categories that can fit into a portfolio. Aren't playing wild games. We're not talking hedge funds here. We're talking core asset management. That's the stock market, high-yield corporate debt, municipal bonds, real estate, and treasury bonds. Those are the categories that are traditionally accepted as components in a portfolio, and also gold, which they don't like to admit, but it's traditional. It's always been there, and yes, if you need it, it's there. Okay. It's now 6 months into the year. Everybody's screaming, and they should be. Most of the asset categories, instead of diversifying or diverging, are in sync with each other. That means government bonds are going down with the stock market. High-yield corporate debt going down with the stock market. Muni bonds going down with the stock market. Real estate going down with the stock. So that when you look at the normal components, you're pulling your hair out if you're an asset manager, because there's no safe place to go. In fact, the Wall Street Journal in last weekend's report said there's no safe place to go. Well, somebody ignored the obvious. Gold is unchanged to up on the year. Here's Friday's numbers, year to date. S&P down 23%. NASDAQ down 31%. High-yield corporate debt down 15%. Muni bonds down 10%. Real estate ETFs down 24.5%. If you want to throw in Bitcoin, down 57%. Yes. U.S. government bonds down 24%. These are double-digit numbers. We're only 6 months into the year. And yet there's that stubborn old gold market sitting there. Yes, it's been under selling pressure since March. But where is it? Last year it closed at 1828.60. We're still up on the year despite all the continued selling pressure. So if you're an asset manager, whether you like gold or not, you look around and say, where's a place I can put some money where at least I'm beating my peers, because I've shifted 5% into gold, let's say. Well, it's gold. And as every week goes by, we said a few weeks ago to our subscribers that, okay, the bears have been selling gold since March, and they keep selling gold usually on Fed-based statements or Fed-based interest rate rises. Okay. They've been doing it since June of last year when the Fed first said they were going to change policy. And gold won't cave. It just will not cave. And I think there's a reason for it. And I think the reason is that once the central banks reach their panic point, meaning they've gone too far, and I'm already hearing utterances from some Fed governors who are even hawks talking about, well, this isn't going to go on forever, meaning the rate rises. The fact that they even say that means that they're scared.
Yeah.
And I'm also hearing a lot of mainstream economists come out and condemn, or not condemn, but at least say, hey, listen, guys, inflation's a problem, but the economy's a bigger one, and this thing's getting out of hand. So our suspicion is, and I think gold knows it, that the central banks ultimately will have to reverse course and do what they were made for, and that is to monetize debt, pay for whatever it takes to stop the collapse of their bubbles, and gold will be the chief beneficiary. So we shall see.
Yeah.
Now, there's a near-term event that
we've
also identified. It's something that over the long term really hasn't impacted gold much, and that's the dollar. Mm-hmm. The dollar, when gold was at its low monthly close in December of 2015, price was $1,060. Since then, gold's done what? It's doubled. Okay, dollar index is now 6% higher than it was 6 years ago, 6.5 years ago. That's all. And yet everybody's screaming about the strong dollar. In fact, it's been a minor little uptick over a 6-year period that did not hurt gold, did not help gold. It was irrelevant to gold. Gold still doubled. Right now we see a situation developing in the foreign exchange markets that could be an ambush, what we call an ambush, meaning something that happens suddenly and quickly and surprises people. And what it looks like is the euro and the yen and some other foreign currencies look like they're ready to turn up, and we suspect you'll see the evidence of that within a couple of weeks, not right now, within 2-3 weeks. And the dollar turned down, and it could be significant. But what it looks like is it could be also rapid, which means surprising. And I think that little bit of wind could help gold. I don't think it needs it, basically, from the long-term basis, but I think it could definitely help. And I also think this downturn in the dollar could be terminal, meaning it doesn't just create a short-term ambush where the dollar caves 4 or 5%, but it gets it going in a more major direction to the downside. So anyway, I think that's an event out there nobody's looking at right now, but we are.
Mm-hmm. Mm-hmm. Well, I think it ties in very well with what you said a moment ago about people becoming worried about the economy. Alistair MacLeod makes the point frequently on this show that the Fed has a choice, basically, between holding asset prices up. That means inflating the currency and keeping air in the bubble, or defending the dollar. And as you're suggesting, it seems pretty clear. History is our guide. Now, they would like us to think that we have the second coming of Paul Volcker now. They'd like us to think that that's possible. I don't see that anywhere possible. Nope. And so I hear what you're saying, and this is interesting to hear from your perspective as a technical analyst from your proprietary technical point of view, that the dollar could be in for a swift demise. I don't think anybody believes that. I don't think many people, anyway, are even thinking in those terms.
There are a few hedge fund managers out there of substance who do hold that same view, based on fundamentals, and they recognize the recent rally, but they dismiss it as likely transitory. Jeff Gundlach is one guy in particular who's recently uttered that view that the next downturn could be serious. As far as Alistair is concerned, he just had an article in the Mises Institute. I suggest to your listeners that they check out the von Mises Institute site.
Oh, good.
It's not technical. It's totally intellectual, economic, and political and libertarian. And I share much with those folks. And Jeff Deist is your guest today, another guest.
Yes,
who heads
we'll ask
the
him about
Mises
that.
Institute. Anyway, I recommend to your listeners they check out the von Mises site. They'll find it quite interesting.
Very good. Very good. Thank you for that, Michael. We'll certainly bring it up with Jeff when we talk to him about it as well. All right, folks. Thank you again, Michael, for being with us. It's always great to have you, and we'll look to talk to you again in a couple of weeks from now.